Welcome to the deep dive. We cut through the noise to bring you the essential insights from business and finance. Today, we're taking a close look at a company you've likely heard of if you follow the energy sector, particularly in Southeast Asia. PTTT, that's PTT Exploration and Production Public Company Limited. Now, you might know them as, well, a dominant force in oil and gas, but what's really going on beneath the surface? We're talking recent performance and, maybe more importantly, their ambitious vision for the future. We've gone through quite a stack of sources for this deep dive, their latest financials, analyst consensus reports, those crucial sustainability statements, and their own strategic plans. So our mission today is pretty clear. Give you a shortcut to understanding the current market feeling around PTTEP, unpack its financial health, and, reveal the big strategic moves the company's making. How are they planning to secure their long-term future amidst this huge global energy shift? We'll look at what the analysts are saying, what the company itself is planning, and what it all means for you, whether you're an investor keeping tabs, a curious learner, or just someone wanting to stay sharp on the energy sector dynamics. Okay, so to kick things off, let's zero in on PTTEP's stock performance. This energy giant, it's seen some, well, really interesting price movements recently. The stock closed at 97.50 back on May 2nd, 2025. Now, what really jumps out is that it saw this continuous, pretty significant decline, dropped a full 21.69% from 124.50 baht on January 2nd, 2025. That's quite a dip in just a few months. And that kind of move, it naturally raises a big question for anyone watching the market. Is this just a temporary blip? A market overreaction, maybe? Or is it pointing to deeper concerns? What's the immediate context here?
Yeah, that's the million-dollar question, isn't it? And what's truly fascinating here is how the analytical community, the brokers, are reading this downturn. Instead of waving red flags, the prevailing view seems to be that it actually presents a potential buying opportunity. As of late June 2025, we looked at the consensus from 21 brokers, and it's overwhelmingly bullish. We're talking nearly everyone recommending a buy. Specifically, you've got 16 buy recommendations, 4 holds, and only one single sell.
Wow, only one sell out of 21.
Exactly. And this strong vote of confidence, especially, coming right after such a hefty price drop, it really underscores this underlying belief in the company's fundamentals, its long-term prospects. It's not every day you see that kind of unified positive outlook after a stock takes a 20+% hit, especially in a sector like energy, which can be, pretty volatile.
That is a powerful endorsement. It really suggests they're looking past the immediate stock chart wiggles. Can you unpack that a bit more? Why are they so optimistic? What are the specific reasons driving these buy calls and the target prices they're setting?
Absolutely. Let's get into the weeds a little with a couple of the prominent firms. Take Landon House Securities PCL, for instance. They put out a buy recommendation, and their target price is pretty robust, 137.0 baht. Now, their analysis does acknowledge, yes, short-term profits might dip a bit, mainly because of swings in Dubai oil prices. That's expected. But their long-term view is really anchored in a projected 3% compound annual growth rate, that's CAGR, in sales volume. They see this steady volume growth providing a really solid foundation for PTTEP's expansion over time.
Okay, so volume growth is the key for them long term.
That's a big part of it. But what really seems to underpin their optimism is PTTEP's, exceptionally strong financial position. This isn't just about having cash on hand. It's about a resilient balance sheet, and they expect that to translate directly into attractive dividends for shareholders. They're estimating a potential dividend yield as high as 8.7%.
8.7%, that's very attractive.
It's incredibly appealing, right? Especially for income-focused investors in this kind of market. And they also highlight something else. PTTT's current share price is trading below its book value. So basically, the company's assets are technically worth more than the market's value in the company at right now. Combine that with a healthy 12% return on equity ROE, which shows how efficiently they generate profit from shareholder money, and Landon House argues these metrics already kind of bake in the impact of current Dubai oil prices. The implication the stock's undervalued. They also have this interesting take on oil prices generally. They suggest a drastic drop isn't super likely because the cost to produce U.S. shale oil, which is a big global supply factor, it's climbed. Used to be around $40 a barrel. Now it's hovering closer to $60.
So that higher production cost acts as a sort of floor.
Exactly. It makes sustained really low prices pretty tough for a lot of producers, so that offers some support.
Okay, so Landon House sees it as basically on sale, with long-term growth and those juicy dividends being the main attraction. Makes sense. What about other analysts? Is Krungsri Securities seeing something similar?
Very much aligned, yes. Krungsri Securities PCL also has a buy recommendation. Their target is 128.000 baht. So slightly lower, but still very positive. Their conviction seems to stem largely from PTTEP's proactive and, frankly, pretty strategic approach to securing new production sources. They're really focusing on regions where PTTEP already knows the ropes, has deep operational expertise, and crucially, has established strong strategic partners. Think Gulf of Thailand, Myanmar, Malaysia, the Middle East.
Right. Playing to their strengths.
Precisely.
Yeah.
And that strategic partner approach, it's key. It lets them share risk, tap into local knowledge, speed up project development, all things that should ultimately boost PTTEP's ROE and give them more stable cash flow down the line. But a key differentiator, Krungsri points out, is PTTEP's, unique revenue structure. We touched on this, but over 70% of their revenue comes from natural gas contracts that use these price formulas.
Price formulas, right. Not just spot market prices.
Exactly. It means their gas prices aren't subject to the wild day-to-day swings you see in the global spot oil market. Instead of being tied directly to a real-time benchmark that can jump all over the place, these gas contracts often have pricing mechanisms linked to maybe a basket of commodities or a fixed formula over a longer period, sometimes with lags built in. This fundamentally cushions the blow compared to peers who might be more exposed to immediate oil price drops. It reduces that severe downside risk.
So more stability baked in.
A lot more stability. Krungsri expects PTTT will keep generating profits above their pre-COVID levels, even at this lower valuation. And they also see potential upside. Scenarios like, what if OPEC Plus cuts production further? Or if U.S. crude supply drops unexpectedly? That could push global prices higher than folks anticipate, which would directly benefit that 30% chunk of PTTEP's business that is tied to oil.
Okay, that's a really comprehensive view from the analysts. Confidence based on financials, strategy, even that unique revenue mix. Given all that optimism, let's look at the numbers themselves. How did PTTEP actually perform recently? Let's drill down into those Q1 2025 results.
MMA, the proof is in the pudding, as they say.
Yeah.
So for the first quarter of 2025, PTTEP recorded a net profit of $488 million. Now, that was actually a 7% decrease compared to the same quarter last year.
Okay. A decrease despite the analyst optimism.
Well, what's particularly interesting is that this dip in profit happened even though the company actually increased its overall sales volume.
Oh, interesting. So volume up, profit down. What drove that?
It points to a challenging market, doesn't it? Where the underlying profitability got squeezed. The decrease was put down mainly to two things hitting at once: a lower average selling price for their oil and gas, and an increase in their operational costs. It really highlights that even if you're producing more, those external price pressures and how well you manage internal costs are absolutely critical for the bottom line.
Yeah, producing more but making less per barrel, that's a tough spot. A real balancing act. Given that Q1 performance, what's the outlook from PTTEP itself for the quarter we're in now, Q2 2025? What are they telling the market?
They give us a pretty clear guidance for Q2 2025. They expect their sales volume to be somewhere in the range of 500,000 to 505,000 barrels of oil equivalent per day, BOED. Now, that's actually projected to be a positive bump, about 3% up from Q1 2025. So that's encouraging on the production front.
Okay, so they expect volumes to keep rising in Q2. What's behind that?
It's driven by several factors, really. Less planned maintenance happening across their fields compared to Q1.
Yeah.
They also increased their stake in the Sinphuhorm project up to 90% ownership as of mid-April 2025, so they get a bigger slice of that production. And importantly, they successfully negotiated an increase in production for the Arthur project. They upped its daily contract quantity, the DCQ, to 330 million standard cubic feet per day, MMSCFD, and that kicked in from June 1st, 2025. So tangible steps boosting output.
Got it. Volume drivers seem solid. What about the price side and costs for Q2?
That's where the pressure continues. They project a gas price of around $5.80 per MMBTU. That's million British thermal units, a standard gas measure. That represents about a 3% decrease from Q1 2025, and it's generally just following the softer trend in oil prices. The latest Dubai oil price, which is that key benchmark for their oil sales, has been hovering around $68 a barrel. That's down about 11% since the start of Q2.
Okay, so price is still soft, and
But
costs
are expected to tick up slightly. Their forecast production cost is around $30 per BOE. That's an increase compared to the same period last year. And the main reason for that is simply having more assets becoming fully operational and ramping up. As new projects come online, or as they increase stakes, like in Sinphuhorm, you often get initial startup costs or integration costs that bump up the overall average before things fully stabilize.
Right, the cost of growth in a way. Yeah.
Exactly. So pulling all that together, the higher volume, but the softer prices and slightly higher costs, PTTEP's preliminary estimates suggest maybe a 5–10% decrease in Q2 2025 profit compared to Q1 2025. So yeah, production volume looks strong, but that combo of pricing and costs is expected to keep pressure on the short-term profit number.
It really sounds like a delicate balance, doesn't it? Where that increased volume is kind of fighting against the pricing environment and those rising costs, at least in the near term. Now, we often hear this discussion, especially when oil prices make headlines, about how PTTEP's performance tracks global oil. There's this common idea, maybe for folks newer to the stock, that it's simple. Oil prices go up, PTTEP stock goes up. Oil down, PTTEP down. Let's unpack that a bit. What's the real story behind their revenue mix? Is it really that direct a link to crude oil swings?
That's such a crucial point to clarify, and yeah, it's a very common misconception. PTTEP is absolutely an energy company, no doubt. But its revenue structure gives it a pretty significant buffer against that famous or infamous volatility of global oil prices. Roughly speaking, only about 30% of PTTEP's portfolio comes from its oil business. That part is more directly exposed to the daily ups and downs of crude markets.
Okay, only 30%. So what's the other 70?
That's the key. The significantly larger chunk, over 70%, comes from natural gas. And this distinction is incredibly important. Why? Because their natural gas sales are mostly underpinned by long-term contracts.
Ah, long-term contracts, not selling on the daily spot market.
Exactly. Think about it like this. Instead of selling gas at whatever the volatile price is today, these long-term contracts provide a much more stable, predictable revenue stream over years. You've got massive projects like G161, that's the Erewhon field, and G261, the Bangkok field. These are huge gas producers, and they're cornerstones of this stability. The gas from these fields is typically sold under these long-term agreements, often with those preset pricing formulas we talked about, or mechanisms that smooth out the price swings over time. Maybe linked to oil, but with a lag or a cap and floor.
So it dampens the volatility significantly.
Hugely. It means that when oil prices suddenly tank, it doesn't necessarily translate into an immediate dollar-for-dollar hit on PTTEP's overall financial performance. That consistent revenue from the gas contracts acts like a big, heavy anchor. It gives them a level of predictability that, frankly, many pure-play oil producers just dream of. It's a real strategic advantage for navigating market turbulence.
That makes a ton of sense, especially in the kind of market we've seen recently. That stability from the gas contracts is a definite plus. Now, connecting that financial strength and structure to their bigger picture, it seems pretty clear that PTTEP's financial discipline, and especially its dividend strategy, are really central to how they deliver long-term value to investors. How does this actually play out in practice? What do their dividend payments look like? How do they manage their finances overall? And what does it tell us about their commitment to shareholders?
You're spot on. Management consistently emphasizes strong financial discipline, effective cash flow management. It's not just talk. It feeds directly into their dividend policy, which is remarkably consistent. Typically, PTTEP pays out dividends twice a year, and their calculation often looks back at performance over the last 3 years, which helps smooth things out and aims for both stability and sustainability in the payout. For example, if we look at the dividend for the fourth quarter of 2024, they paid out 5.12 BAT per share. The XD date, the date you needed to own the stock by, was February 25th, 2025. When it was paid in April, that worked out to a yield of about 4.45%. Pretty solid.
Okay, twice a year, looking back 3 years. That sounds geared towards consistency.
It absolutely is. And if you look back further, their dividend payments have pretty regularly yielded somewhere between, say, 3% and sometimes even over 8% in recent years, depending on the share price and the payout amount. And this isn't just a recent thing. PTTEP has this long, quite impressive history of regular dividend payments going all the way back to 1993.
Right, since 93.
Yeah. Now, the exact amounts have obviously varied with market conditions and company performance over those decades, but the regularity, the commitment to returning value, that's undeniable. Remember land and house securities we mentioned earlier? They specifically called out that attractive dividend yield, estimating it could hit 8.7% as a key reason for investors seeking stable income to look at PTTEP. So that long track record really positions them not just as an energy stock, but as a pretty reliable income generator. That's kind of rare in such a dynamic, often volatile sector. It provides a predictable return even when the market's choppy.
That history really does paint a picture of commitment. Beyond those dividends, how are they managing the operational side, the efficiency? What about profitability metrics like EBIT, especially with these shifting market conditions?
Yeah, operational efficiency is definitely a top priority for them. PTTEP is aiming to maintain a very strong EBITDA margin. Their target range is 70–75% for Q2 2025, and actually for the full year as well.
70–75% EBITDA margin. That sounds high.
It is very robust for any industry, really. EBITDA, just quickly for listeners, is earnings before interest, taxes, depreciation, and amortization. It gives you a clearer picture of core operational profitability, stripping out financing and accounting stuff. So targeting 70–75% indicates exceptional cost control and really efficient operations within their core E&P business. And importantly, that target is consistent with what they achieved last year, so it signals the sustained focus on keeping profitability high.
Okay, and how do oil prices fit into that EBITDA picture and those rising costs we talked about?
Good question. Their forecast average oil price for 2025 is in the range of $65 to $75 per barrel. Now, it's worth remembering that this range is significantly higher than the historical cost of U.S. shale oil production, which used to be maybe $40, but is now estimated closer to $60 per barrel, as we discussed. That higher cost benchmark does provide that sort of floor. Now, their oil portfolio, that 30% slice of the business, is obviously impacted by where prices land within or outside that 65–75 range. But PTTEP isn't just sitting back and hoping for the best. They use dynamic hedging. That's basically using financial instruments, futures, options, swaps to lock in prices or protect against downside risk for a portion of their expected oil production.
So they're managing the price risk.
Exactly. By using these financial tools, they can offset potential losses if prices fall unexpectedly. It helps protect their oil revenues to a significant degree, and that's a key factor in allowing them to maintain that ambitious 70–75% EBITDA margin target, even when the market gets bumpy.
It's really clear they're disciplined financially, strategically managing the existing operations. But okay, looking beyond the immediate numbers, beyond the current operational strengths, what I find really compelling about PTTT is their forward thinking, their vision. How are they actually positioning themselves for these massive shifts happening in the global energy market, the transition, sustainability? What does that strategic roadmap actually look like?
That's exactly where their big overarching strategy comes in. They call it Drive, Decarbonize, Diversify. It's a three-pronged approach, and it's the guide for their entire 5-year operational plan, running from 2025 through 2029. It's essentially their blueprint for navigating these huge changes in energy.
Drive, decarbonize, diversify. Okay, let's break that down. What's drive?
Drive value is the first pillar. This is all about basically squeezing the most value out of their existing core business, the petroleum exploration and production, E&P. It means optimizing the assets they already have, making sure that core engine remains highly profitable, efficient, and continues to deliver that crucial energy security for Thailand and their partners. It's the foundation, keeping the lights on and the cash flowing.
Makes sense. Maximize the core. What about decarbonize?
Pillar 2, decarbonize. This is a direct, stated commitment to actively reducing their greenhouse gas emissions. PTTEP has set a pretty ambitious net zero target by 2050. Now, that's specifically for Scope 1 and Scope 2 emissions.
Scope 1 and 2, remind us what those are.
Right. Scope 1 covers emissions directly from their own operations, like burning fuel on rigs or in facilities. Scope 2 covers indirect emissions from the energy they purchase, like electricity to run their offices or plants.
Yeah.
So hitting net zero on those by 2050 is a big goal. And it's not just talk. They see it as a fundamental shift in how they need to operate going forward.
Okay. And the third pillar, diversify.
Diversify is about expanding their investments into completely new energy businesses and advanced technologies. This pillar is squarely aimed at aligning with the global energy transition. It's about ensuring they stay relevant, find new growth avenues in a world that's increasingly demanding cleaner energy solutions. Think renewables, hydrogen, maybe carbon capture as a service. We'll get into the specifics. But that three-part framework, drive, decarbonize, diversify, shows how they're trying to balance today's energy needs with tomorrow's sustainable growth demands. It's woven into everything they're planning.
That is a truly ambitious and frankly necessary vision for an energy company today. It immediately brings up the critical question, though. Money. How much are they actually investing in this grand strategy, and where exactly is that money going? What specific projects are they focusing on to turn this vision into reality?
Yeah, the investment is substantial. PTTEP has earmarked a massive budget for this 5-year plan, 2025 to 2029. The total figure allocated is $33,587 million.
Whoa, wait. Over $33 billion.
Billion with a B, yes. Over 5 years. It's a huge commitment. And that's strategically split. Capital expenditure, or CapEx, that's money for new investments, major upgrades, building stuff, gets $21,249 million. Operating expenditure, OpEx, the day-to-day running costs, gets $12,338 million. Just for 2025 alone, the budget is $7,819 million. That's nearly $8 billion in 1 year, with about $5.3 billion of that being CapEx for growth and transformation and $2.5 billion for OpEx. This isn't just tinkering around the edges, it's serious investment.
Okay, nearly $8 billion just for 2025. Where is that CapEx primarily going? What are the priorities?
It's channeled into three main operational pillars, aligning with that strategy. Pillar number one is increasing production from core projects. This gets the biggest chunk of the 2025 CapEx, $3,676 million, so over $3.6 billion. The focus here is squarely on those critical projects that support Thailand's energy security. We're talking ramping up production at G161, the Erawan field. They have a big target there, 800 million standard cubic feet per day. Optimizing G261, the Bongkot project, plus that increased output from the Arthur project we mentioned, pushing it to 330 MMSCFD from June 1st. Also key domestic fields like S1, Contract 4, and their share in the Thailand-Malaysia Joint Development Area. Internationally, it includes boosting production from Myanmar's Zawtika and Udana fields. Remember, those supply crucial gas to Thailand and major projects in Malaysia and Oman. So job one is getting the most out of what they already have.
Right, driving value from the core. What's pillar two?
Pillar two gets $1,464 million in CapEx for 2025, so around $1.5 billion. This is accelerating development phase projects. This means pushing forward the big projects that are currently being built and developed, making sure they start producing on schedule. Key examples are the Gasha concession and Abu Dhabi Offshore 2. And a really big one, Mozambique Area 1. There are positive signs there now, and they're accelerating development. Production from that huge LNG project is now expected by late 2028. Speeding that up is a major focus.
Mozambique LNG, right? That's a world-scale project.
Absolutely massive. They're also actively developing several Malaysian projects, SK405B, SK4017, SK438. They're aiming for a final investment decision, or FID, on those late in 2025. FID is that crucial point where you commit the big bucks to actually build it, and they're doing exploration drilling there right now. So this pillar is about turning future potential into actual barrels and cubic feet.
Okay, core production, accelerating development. And what's the third pillar? Less money allocated here, I think you said.
All right, the third pillar is intensifying exploration with $127 million in CapEx for 2025. Seems smaller, but it's vital for the long term. This involves drilling new exploration wells, looking for brand new discoveries, and appraisal wells, which help define the size of discoveries already made. They're doing this in existing areas and new blocks across Thailand, Malaysia, and Myanmar. Why bother when you have huge fields already? Because you constantly need to replenish your reserves, find new commercial resources to replace what you produce, and ensure growth beyond the current project pipeline. It's about feeding the beast long term.
Finding the next Erawan or Bongkot, basically.
That's the dream, exactly. And on that note, PTTEP recently won bids for two brand new exploration blocks right in the Gulf of Thailand, G165 and G365. What's smart is that these blocks are strategically located right near their existing operations. If they find something, they can potentially develop it faster and more cheaply by tying it into existing platforms and pipelines, leveraging all that infrastructure and know-how they already have nearby. It's smart exploration.
That makes sense, balancing immediate production needs with ensuring there's something coming through the pipeline years down the road. It's clear they're investing heavily across the board in E&P. With all this spending, what are their actual production forecasts looking like? What kind of volume growth are they expecting over the next 5 years?
Yeah, they've put out some clear numbers based on these plans. For 2025, they're projecting petroleum sales volume around 507,000 barrels of oil equivalent per day, 507 kboed. That's expected to ramp up to about 541 kboed in 2026. There's a slight projected dip in 2027 down to around 528 kboed, maybe due to timing of projects or natural field declines before new stuff comes online. But then the acceleration really kicks in. They forecast a significant jump to approximately 585 kboed in 2028.
Wow, quite a leap in 2028.
Yeah, that's likely when projects like Mozambique and some of those accelerated developments really start contributing meaningfully. And then it stabilizes around 581 kboed in 2029 based on this 5-year outlook. So it shows a clear growth trajectory, especially towards the back end of this plan, as those big investments start paying off in terms of production volumes, reflects their confidence in bringing that new capacity online.
Okay, so the traditional E&P side looks set for growth. But going back to that bigger picture, the future of energy. Beyond optimizing oil and gas, how is PTTEP really positioning itself for that broader shift, the sustainability push, the lower carbon world? How genuinely are they embracing the energy transition, and what specific steps are they taking beyond just talking about it?
This is where those decarbonize and diversify pillars really flex their muscles, showing they're looking beyond just barrels. First off, on the credibility front, PTTEP has earned significant international recognition for its ESG performance, environmental, social, governance. This isn't just internal PR. These are external validations. For example, in 2024, for the 10th time, they were selected for the Dow Jones Sustainability Indices World Index, the DJSI World, specifically for the oil and gas upstream and integrated industry. That's a big deal globally. They've also been listed in the Sustainability Yearbook by S&P Global for 11 straight years, and recognized by the FTSE4Good Index Series for 9 consecutive years.
Okay, DJSI, S&P, FTSE, those are major ESG benchmarks. What does that actually mean for the company and for investors?
It means a lot, actually. These aren't just participation trophies. Consistent inclusion signals that PTTT has deeply integrated sustainability into its core strategy and operations. It implies robust governance structures, leading-edge management of climate-related risks, innovative approaches to things like water use, waste management, community relations. For an investor, it suggests PTTT is actively mitigating future regulatory risks, environmental risks. It makes them more attractive to that huge, growing pool of ESG-focused institutional money. It can potentially lower their cost of capital because they're seen as less risky and more forward-thinking. It positions them as a leader, not a laggard, within the energy sector on responsible practices.
Right. It's about long-term resilience and reputation, too. So specifically on decarbonization, you mentioned the net zero target. Can you recap the details there?
Sure, they've made that firm commitment. Net zero greenhouse gas emissions by 2050 for Scope 1 and Scope 2. And crucially, it's backed by concrete interim targets. They're aiming to slash their greenhouse gas emission intensity, that's emissions per unit of production, by at least 30% by 2030 and by 50% by 2040. And the baseline for that is their 2020 emissions level.
So clear milestones along the way. Are they budgeting for this?
Yes, they've allocated a dedicated budget just for GHG reduction activities in 2025 alone, $77 million. And they're showing progress. By the end of 2023, PTTEP reported an accumulated GHG reduction of over 2.4 million tons of CO2 equivalent since they started tracking seriously. So it demonstrates tangible progress, not just future promises.
That's significant reduction already. What about specific technologies? Carbon capture and storage, CCS, is often talked about. Is PTTEP doing anything concrete there?
CCS is absolutely a major piece of their decarbonization puzzle. And yes, they're moving beyond just studies. PTTEP has completed the front-end engineering design for their big CCS project planned for the Arctic gas field right there in the Gulf of Thailand.
Theft complete. So that means the detailed engineering and planning is done.
Exactly. It's a critical step that moves the project from being a concept on paper to being ready for construction and implementation. Big milestone. They expect this Arctic CCS project to be up and running by 2027. And once it's operational, this single project is estimated to capture and store somewhere between 700,000 and 1 million tons of CO2 equivalent per year from their production operations.
1 million tons a year, just from one project?
Potentially, yes. To put that in perspective, that's like taking several 100,000 gasoline cars off the road every year. It's a substantial chunk that will directly contribute to hitting those net zero targets and really showcases their commitment to deploying advanced environmental tech. But their vision, under that diversify pillar, goes even further than just cleaning up their existing operations. They're actively investing in completely new energy businesses. Remember that big 5-year budget? There's an additional $1,747 million, nearly $1.8 billion, specifically reserved just for expanding into these new energy ventures over the next 5 years.
Okay, almost $1.8 billion for new energy. What kind of things are they investing in?
Several key areas. One is offshore wind energy. For instance, they've made an indirect investment in the Seagreen offshore wind farm, that's off the coast of Scotland, and it happens to be the largest offshore wind farm operating there. Now, this isn't just about planting a flag. It generates immediate revenue for them, but maybe more importantly, it provides invaluable hands-on learning and practical experience in a sector, offshore wind, that's growing exponentially worldwide.
So learning by doing, basically. What else?
Another major focus is green hydrogen fuel. They're part of a large-scale green hydrogen development project in Oman. This involves 5 global partners, and the idea is to leverage Oman's incredible solar and wind potential, some of the best in the world, to produce hydrogen using renewable electricity. That makes it green hydrogen, with zero carbon emissions in production.
Green hydrogen, that's seen as potentially huge for decarbonizing heavy industry and transport, right?
That's exactly. It's a forward-looking bet on a fuel source that could be revolutionary. It's still early days commercially for large scale, but getting involved now positions them well. They're also exploring the idea of CCS as a service. Leveraging the expertise they're building at Arthid, they might eventually offer carbon capture and storage solutions to other industrial companies looking to cut their own emissions. That could be a whole new business line. And finally, they're making investments through their corporate venture capital arm CVC subsidiaries. These act like internal VC funds, investing in various emerging businesses and cutting-edge energy technologies. This keeps them plugged into the innovation ecosystem, helps them spot the next big thing, maybe technologies that aren't even mainstream yet. It's this really holistic approach, offshore wind, green hydrogen, CCS services, venture capital, that signals PTTEP is seriously trying to transform itself into a much broader energy solutions provider for the future.
That's a truly significant push into new energies. Clearly diversifying beyond just oil and gas for the long term. Now, besides growing organically and making these new energy bets, are they also using mergers and acquisitions M&A to speed things up or gain specific assets, especially overseas?
Yes, absolutely. M&A and strategic partnerships are definitely a key tool in their growth toolbox. PTTEP is actively scouting for new investment opportunities, especially outside Thailand, through acquisitions. Their focus for M&A is quite specific and, well, pragmatic. They're primarily looking for natural gas projects. Why gas? Because it aligns with their core strength in that stable revenue base we discussed. And they prefer projects that are either close to starting production or are already in their early production phases.
So less risky exploration plays, more about assets that can contribute cash flow relatively quickly.
Precisely. It allows for faster integration into their portfolio, quicker revenue generation, and it leverages their deep operational expertise in natural gas. They're not using M&A primarily to gamble on finding the next giant discovery. It's more about adding proven or near-proven resources. Geographically, their shopping list remains focused on areas where they're already comfortable and have a presence. Thailand itself, broader Southeast Asia, the Middle East, and parts of Africa. And they really emphasize collaborating with what they term strong strategic partners in these regions. Partnering up helps de-risk new ventures, it shares the hefty capital costs, and crucially, it brings in local knowledge and relationships. It's a smart way to expand internationally without biting off more than they can chew alone.
Makes sense. Partnering for strength. You mentioned their high investment budget earlier. Does that M&A appetite affect other things like share buybacks?
That's a relevant point they addressed. While they maintain this very high investment budget, averaging around $4.2 billion per year across E&P, new energy, and potential M&A, they've explicitly stated that, for now, they don't see share buybacks as suitable. Their reasoning is that prioritizing these substantial, long-term strategic investments, both in traditional E&P growth and in building out these new energy platforms, is the best use of capital right now to drive future value. It really underscores their focus on investing for significant long-term growth over using cash for shorter-term shareholder returns like buybacks.
Okay, so what does this all mean? We've journeyed through PTTEP's current financial picture, their ambitious strategies for growth in both old and new energy, and their deep commitment to sustainability and the energy transition. We've seen a recent stock price dip that analysts, interestingly, view largely as an opportunity. We've seen a solid track record of consistent dividends. We've seen them optimizing traditional assets like Erawan while simultaneously pioneering things like green hydrogen in Oman and major CCS projects. PTTEP is clearly navigating a really complex, fast-evolving global energy landscape. It seems they're trying to balance their traditional strengths with some bold, future-facing investments, not just reacting, but actively trying to shape their path forward.
That's a great summary. It's really evident PTTEP isn't just passively reacting to market shifts. They're proactively trying to shape their own future, steering towards a lower carbon footprint while still fulfilling that crucial role of ensuring energy security for Thailand and the region. Their integrated approach is quite striking, sustaining heavy investment in their traditional E&P powerhouse while also allocating significant capital, billions, towards these cutting-edge energy solutions. It's a powerful statement about how a legacy energy company can try to evolve. And this really raises an important final question, perhaps, for you listening to consider. Given this extensive parallel investment in both traditional E&P and these new energy frontiers, how might PTTEP's integrated model actually redefine what we think of as an energy company over the next decade? And beyond just redefining themselves, what new opportunities might this unique blend, this combination of established stability and forward-looking innovation create, not just within their current regions, but potentially on the broader global energy stage. It's certainly a fascinating transformation to watch unfold.
Definitely food for thought as you reflect on this deep dive into PTTEP. Thank you for tuning in to the deep dive today. We hope this exploration has given you a clearer, more nuanced understanding of PTTEP and the incredibly dynamic energy sector they operate in.